A single signature in London can make your groceries, gasoline, and online orders more expensive by tomorrow, even if no ship actually sinks. The hidden lever is called the war risk premium, and when it moves, entire trade routes are repriced before most consumers even know a missile was launched. What is this exactly? It is the extra insurance charged when a ship enters waters suddenly judged dangerous. Not cargo damage in general, not normal marine cover. A specific financial toll attached to geography, conflict, and legal wording. And my view is simple. This is one of the least visible choke points in global trade because a tiny circle of insurers, brokers, reinsurers, and P&I clubs can turn military tension into consumer inflation with astonishing speed. Start with one voyage. A tanker leaves the Gulf. A container ship heads through the Red Sea toward the Suez Canal. The ship owner already carries hull insurance for the vessel and protection and indemnity cover through a P&I club for liabilities like pollution, crew injury, or collision claims. Then, the route is reclassified as exposed to war, terrorism, drones, mines, or missile attack. Suddenly, the owner may need an additional premium, often quoted as a percentage of the ship's value, for a very short period, sometimes just 7 days of transit. That sounds technical. It is not. Imagine paying for a plane ticket, then learning that crossing one airport corridor adds a last-minute security fee equal to a mortgage payment. On a vessel worth $100 million, even a 0.5% war risk quote means $500,000. At 1%, it is $1 million. If the ship is a large crude carrier or a modern LNG vessel worth much more, the math gets uglier fast. Reuters reported in late 2023 and early 2024 that war risk rates for Red Sea transits surged sharply after Houthi attacks, with some quotes multiplying several times within days. That is not noise. That is pricing power. People often assume shipping costs rise only when a ship is destroyed or a canal is blocked. But the real repricing often happens earlier, in documents, calls, and clauses. A broker in London asks for terms. An underwriter tightens conditions. A reinsurer raises the cost of backing that exposure. A joint committee updates a listed area. A P&I club warns members. And just like that, the route is no longer the same route. It is the same water, but financially, it has become a different ocean. Here is where the system gets concentrated. The marine insurance market is global, but the center of gravity still runs through London, major specialty underwriters, and the international group of P&I clubs, which collectively insures around 90% of the world's ocean-going tonnage liability exposure. That number matters. It means the liability backbone of world shipping is not scattered across thousands of equal players. It is clustered. And clustered systems can move fast, but they can also transmit stress with brutal efficiency. The mechanism works in layers. Hull and machinery insurers cover the ship itself. P&I clubs cover third-party liabilities. Reinsurers sit behind them, absorbing part of the catastrophic risk. Brokers connect the client to the market. Sanctions lawyers review whether a claim could even be paid legally. If missiles begin flying near Bab el-Mandeb, each layer becomes more cautious. Each layer adds cost, exclusions, or delay. Ask yourself, when every layer in a chain gets more defensive at once, who ends up paying? The supermarket shopper rarely sees the invoice, but they pay it anyway. The evidence is not theoretical. The World Bank warned in early 2024 that disruptions in the Red Sea pushed up shipping costs and transit times. The IMF noted that freight rates on some routes rose sharply as vessels rerouted around the Cape of Good Hope. S&P Global and market brokers tracked war risk premiums jumping multiple times above prior levels for ships still choosing the Red Sea. Meanwhile, Clarkson's and Zenita data showed broader freight volatility as carriers adjusted networks. One narrow corridor became a pricing signal for the rest of the system. And this is where the hidden thesis gets stronger. The premium is not just about danger. It is about uncertainty that can be legally priced. That distinction matters. A missile hit is a physical event. A premium hike is a financial interpretation of probability, legal enforceability, and worst-case aggregation. In plain English, the market is charging not only for what happened, but for what could happen, what might be excluded, and what could spiral into a chain of claims. That is why food, fuel, and consumer goods all feel it. Oil and refined products face higher voyage costs. Container lines add surcharges or rerouting costs. Bulk carriers carrying grain and fertilizer face longer paths and more uncertainty. By January 2024, some Europe-Asia container services had shifted around southern Africa, adding roughly 10 to 14 days depending on the route and vessel speed. More fuel burned, more crew time, fewer ships available for the same schedule. Insurance was not the only cause, but it was one of the first costs to move. I think this is the part most coverage misses. We talk about choke points as places on a map: Suez, Panama, Malacca. But some choke points are contractual. A clause can be as powerful as a canal. A listed area notice can hit margins faster than a naval escort can calm them. That is a strange truth of modern trade. The invisible architecture of risk often matters as much as the visible architecture of steel. Many hook, and the most important decision may happen before the ship even leaves port. Charter contracts decide who pays what. Sale terms decide whether cost, insurance, and freight are bundled or shifted. Carriers decide whether to absorb a premium, pass it through, or avoid the route entirely. So when viewers ask, why did my delivery get pricier if no vessel sank? The answer is that commerce does not wait for disaster. It reprices at the expectation of disaster. There is also a feedback loop. Higher risk premiums encourage rerouting. Rerouting lengthens voyages. Longer voyages tighten vessel supply. Tighter supply lifts freight rates. Higher freight rates make cargo owners more sensitive to delays, which increases the value of certainty, which can justify paying even more for secure alternatives. This is classic chain reaction economics. One insurance signal can ripple through chartering, fuel demand, inventory planning, and retail pricing. But wait, the strangest part is that the system can become more expensive even when attacks are limited, because the real fear is accumulation. Insurers are not only asking, will this ship be hit? They are asking, what if several ships are hit, claims are disputed, salvage is delayed, crews are harmed, pollution follows, and sanctions complicate payment? That is the twist. The premium is not pricing one explosion. It is pricing a legal and financial cascade. That cascade matters because marine insurance is deeply intertwined with banking and trade finance. Banks financing cargoes want compliant cover. Ports want proof of insurance. Charterers want certainty that liabilities are covered. If coverage becomes too expensive or too narrow, some operators hesitate, some reroute, and some demand much higher compensation. Could a cargo still move? Yes. At the same price? Usually not. Look at the concentration again. The international group's clubs include names like UK Club, Guard, North Standard, and Britannia. Lloyd syndicates and specialty marine underwriters remain central in placing complex risk. This does not mean a secret cartel sets your serial price. It means a small, expert ecosystem acting rationally under pressure can still produce economy-wide consequences. That is more unsettling, in my opinion, because nobody needs to conspire. The structure itself does the work. Mini hook. And once traders believe the premium will stay elevated, behavior changes before invoices fully arrive. Importers build buffer stock. Refineries adjust sourcing. Retailers hedge or raise prices early. If you have ever wondered why inflation sometimes feels ahead of the headline event, this is one reason. Markets price routes in anticipation.